Hey guys, this is Maya B, your favorite fintech nerd. Welcome to Fintech Book Club. Today we're going to be talking about payment systems in the US. This is a gold standard book on fintech and how payment systems work in the US. It's been recommended to me a gazillion times. I'm only just getting now to reading it. I was intimidated by starting this book a little bit, and so I've decided to do it chapter by chapter. This is the first one. So I'm going to do a recap of the first real chapter, which is chapter 2, overview of payment systems. Now, because this is a recap and it's an overview, it should be a pretty chill time. So let's dive in. Okay, so this book was written by Carol Coy Benson and other partners at Glenbrook. I know that they do sessions and consulting, and that's the business they're in. Never met Carol, but she seems like a badass. I know that she kind of like owns this whole space, and her book is the best book. So hope to meet her one day. Love it. They got the table of contents, got an introduction. Payments are important. I believe this. You probably believe this. Let's get started. So payment systems overview. What is a payment, right? Transfer of value. This part I kind of skimmed through. I think makes kind of a lot of sense. See, the two most common models are open loop and closed loop. I don't know exactly what this means. I've heard these discussed a bunch. I believe that it is, so I'm excited to learn. I believe it's something about like, you know, when I look at the back of my Chime Visa debit card, it says this card is issued by the Bancorp Bank, right? It's the underlying banking partner for Chime. When I look at my Amex card, it doesn't say that. Right? When I look at my Apple card, it says it's issued by Goldman Sachs. So I think it's like these are related to how Amex is closed loop. I think with the card networks, it feels like the open loop models need an intermediary as the banking partner, and the closed loop models like Amex don't. But I don't understand all the details there. So I hope to understand at some point. Right, and this is what it shows. So like with the card networks, the payment system would be like a Visa or a MasterCard. Underlying banking partners are there, and then the end parties is you and me and the blue bottle that I buy coffee at. Now, I'm always really interested in liability. This just like briefly discusses how if a customer initiates a dispute that requires a transaction to be reversed. So this is like if somebody else got access to their payment issue information and made an unauthorized transaction on their card, right? Well, then the merchant's kind of the one holding the bag. I know that there was a big liability shift in October 2015. And so I'm curious how that plays into this. It was called the EMV liability shift, and I have it here. I just kind of Googled it. And basically, so what the EMV liability shift says is that it used to be that the issuers, people like Chime and Goldman Sachs and your Apple card, they used to have all of the liability for if there was an unauthorized transaction. But since October 2015, for cards with that fancy EMV chipset on them, that's no longer the case. If the card has an EMV and the merchant chooses to run it as a magstripe transaction instead, and that turns out to be fraudulent, then now the merchant is held liable. And this is helping increase the adoption of EMV, which, you know, everybody's excited about. I'm interested to see how that goes, right? Discusses closed loop, right? Original Amex, so this must be related. Payment services providers such as PayPal and Western Union. So I wonder if this is like this because basically PayPal, if I send you a PayPal payment, you have to use PayPal to receive it. While if I send something if I use my Goldman Sachs card at Blue Bottle, they don't have to have Goldman Sachs to receive that payment. I wonder if that's kind of what's at the heart of the open loop versus closed loop. Oh, I love the history of clearing systems like this. I think this stuff is really funny and really interesting. I don't know, I feel like all the financial systems have funniest history. this is cool. So it says other terms in open loop payment system. Now on us transactions, right? The bank settles a transaction through an internal book transfer. So this must be like Chime has a feature called Pay Friends. It's a peer-to-peer option that allows any Chime member to send money to any other Chime member, right? And that just happens. It doesn't happen through the card networks or through ACH. It's just peer-to-peer. It happens instantly. It's free for Chime members. It's not free for Chime, but it's very, very, very cheap compared to something that goes through an intermediary. So it's faster, more efficient. And it's funny that this says like other terms in open loop payment systems, because based on the previous descriptions, I would almost think that an on-us transaction like this is part of a closed loop payment system, and it has those efficiency gains and that you get from disintermediation, but it has the same limitations as any closed loop system, which is that it's hard to scale, right? It's like, I think Chime's Pay Friends is the best way to send money to your friends, and it is, right? It's like fastest, it's instant, it's high visibility, you can spend it immediately, it has all of these great features, but it only works with other Chime members, and that's the big downfall. So I guess I don't quite understand this. That feels like that would be a closed loop system. I also thought this was interesting. It says many smaller banks in the United States gain access to the wire transfer system through a correspondent banking relationship. This must be how my bank, Charles Schwab, does it. I know that when I give someone wire instructions to send a wire to my Charles Schwab account, it actually says to send it to Citibank, which always makes me nervous. I'm like, how am I going to get my money if it's going to Citibank? But I wonder if now it's because Charles Schwab is using a correspondent banking relationship in order to access the wire system and provide that. So that would actually be kind of cool. Farther down here on this page, let's see, we're on page 14. It says the 5 core payment systems in the United States. It's just kind of interesting. Like, I think of the checking system as the same thing as ACH. I don't think of ACH as like digital automated checks. And so I kind of conflate those in my head. And I'm curious, like, they must be different. And like, what exactly is a payment system such that there are 5 and these are different? Ooh, volumes. I always love a piece of data. Let's look at this. So debit, credit, I think these are 2015 numbers. That's like average value of $30 for a debit card transaction. That makes sense to me. That's about what I would have guessed. The credit is actually higher than I would have guessed. I would have thought maybe $70 for an average credit card transaction. Here it's got 92, which I'm sure this varies a lot by demographic. These are also 2015 numbers, so things might have changed in the last couple of years as credit access grows. It also digs into, interesting, ACH, the average is $1,700. That's a lot higher than I would have guessed. I mean, I use ACH to pay my rent. I use it to pay my credit card bills. I do smaller transfers just between my accounts. $1,700 feels really high, but this is, it's not just consumer banking, it's also business banking. And so when you combine all the bills that businesses are paying over ACH, I think it makes sense that you're going to get a higher average. Okay, note that wire transfers are excluded. That makes sense to me. Wire transfers are massive because even ACH is massive, right? It's $41 billion in volume in 2015. I think we see this with like startups. I see startups push me all the time talking about making ACH faster, reducing fraud, increasing visibility, lots of cool stuff in that space. And they always talk about how it's such a powerhouse within the US financial system, and it goes a little bit under the radar sometimes, I think. Processing, excited to learn more about settlement. I'm always a big fan of that stuff. Maybe looked at this stuff. Domains of payment. So it goes over point of sale, remote commerce, bill payment. This all makes sense to me. I thought this was interesting, this like peer-to-peer payment section. I really think of peer-to-peer as sending to other people, but it says that like account-to-account transfers by individuals also gets classified as peer-to-peer. So same thing, I mean, in Charles Schwab, when I connect an external account and then transfer money there, it's counted as a peer-to-peer payment, even though I really just think of it as a transfer myself. So, I mean, I wonder if the better way to think of this category of payments is really personal payments, right? Whether to another person or amongst your own individual accounts. So then we're getting into payment flows, which I always find super, super interesting. Talking about push payments and pull payments. So I highlighted this part here, right? It's basically like by depositing a check, you are starting a pull transaction, which I guess makes sense now that it's written it. I would have never thought of checks as a pull transaction before. And I think as a consumer, you really think that you're pushing funds, like when you write a check, that somehow like that is pushing funds to the recipient. But actually all a check is its authorization that that recipient is allowed to pull funds from your checking account. It's like, hey, here's my routing account number and my signature and like the amount that I'm authorizing you to pull from. And it's just that pull transaction. And I know that the technical definition of a check is really just the relative location of all of those elements. So your signature, the routing number and account number, the payee, all of that information. And technically, like you could write that information on like a gum wrapper. And as long as it was in the correct relative locations, that is technically a check, right? And that makes so much more, like I've known that fact for a long time, but it makes so much more sense to me now that I just think of checks as authorizations for someone to issue a pull payment on your account. And so I think it's like, I don't know, this is just like making so much sense to me for like the first time, which is really funny. It's very interesting. And I know that checks do have all these other technical features, right? So like the bottom line where your account number and routing number is printed in that funny font, it's called the microline. It's printed out in magnetic ink typically because that makes it faster to be read by specialized check readers if the check is being physically processed. So checks do have all of these other technical elements. Sometimes they have watermarks and stuff like that, but it really is just an authorization for a pull transaction. I mean, this was new to me and it's kind of blowing my mind here. I find that like super, super interesting. So now push payments are way, way less risky compared to pull payments, right? And I'm trying to tell people this all the time. Actually, I tweeted recently about this because my friends are always complaining about how hard it is to send money between like their accounts, and especially if it's a lot of money. And so I tell them, like, most of the time they're kind of doing it wrong. Like the best way to be able to send a bunch of money between two accounts you own is to go into the account that has all the money and push money from that account to the account that you wanted. I always hear about my friends who have, they try to initiate it from the account that doesn't have the money yet and pull it in. And that's a much riskier transaction, right? And so here's the thing is because it's less risky to push that money, the way that that risk gets materialized is you're going to have much higher limits. I think I have like 20x the limit on my Charles Schwab account for money I can push out compared to money that I pull in. And so, yeah, this is something that I think people often don't understand. It's like much less risky. Now, it also is talking about, right? So pull payments, it says the bank initiating the transaction does not know whether the bank receiving the transaction will be able to successfully apply that transaction to the credit debit account of the customer. I feel like this is begging for a startup to get in this space to solve this. I mean, this is basically what technology is good for, right? It's like we have better forms of communication. We can access more data. We can do things securely. Like, these transactions are risky because you don't have a real-time understanding of the balance and like whether it's going to be approved or not. There's a huge opportunity if we can reduce the risk there. Also highlighted, it says a signed check presented to a merchant or a card swipe with signature or PIN are examples of such authorizations, right? So those are just authorizations of pull payments. What I was talking about earlier with checks, and then here, right, it says it's like all card transactions are fundamentally pull payments, right? So anytime you swipe your card, all you're doing by signing that or by typing in your PIN is you're authorizing that merchant to pull those funds from your account. I highlighted this bit about fraud because I'm always interested in that. It says card network rules specify that merchants receiving this yes are covered for both insufficient funds and fraud risks, important differences in e-commerce and other environments in which the card is not present. It's actually the environment that first occurred to me was airplanes. So airplanes run their onboard purchase transactions offline. What that means is when you're buying like a snack pack on American Airlines, they take your card and they swipe it, but they're not getting a real-time authorization for that purchase. And so you could swipe a debit card that doesn't have any money in it, and they're not going to know. They're just storing that information so that when they land, they run all those purchase transactions. Now, if they land and you don't have money in your account, well, that transaction isn't going to go through. And I don't know who holds the liability for that. If airlines are sophisticated, my guess is that they're not going to be excited about selling you an airline ticket in the future if you do stuff like this and if you drink too much booze without paying for it. But I don't know how sophisticated airlines are. It's like kind of hit or miss there. Goes into payment system settlement a little bit, right? So it says settlement of checks in ACH handled through the Federal Reserve Bank is done on a batch basis. Now, this technically happens 4 times per day on Arizona time. And it happens on Arizona time zone because Arizona doesn't have daylight savings. So it's kind of an interesting thing that will happen is if you live in a place that does have daylight savings, you might notice that your transactions happen differently when you cross that transfer of daylight savings relative to Arizona time, because those batches are being processed on like a different time than they used to before you crossed over into this new daylight savings time. So just kind of an interesting thing there. This is funny. This whole thing about like how money actually moves is, I almost feel like that's a joke because so few people really understand how money actually moves. And it's just like digits in a computer for a long way down. The new world of settlement, I think this stuff is super interesting. Basically, historically, it's operated on, like ACH has operated on a high level of trust and on regulation on included entities. I think in some ways they're trying to open that up so that more people can be involved. But in order to involve more parties there, you're going to have less. You're not going to want to extend as much trust to them, and so they're going to be pre-funding. It's interesting to kind of watch people navigate this stuff. Okay, it talks about these virtual systems. I don't quite understand like what makes this a virtual system, but I do think it's funny how it talks about cash, right? And says cash is effectively a push system, right? So it's less risky. The funds are basically guaranteed. This is why people like conducting transactions in cash. Now, this is kind of cool. It talks about whether things are owned by a bank or not. You know, Visa is like spun out of Bank of America. Now it's not associated with banks. It doesn't own any banks. I think that's kind of an interesting, I mean, they probably get some regulatory relaxed rules because of that. But I do think there's an interesting opportunity for Visa to own a bank and offer some like vertical integration and like more efficiencies there. I think that stuff is super interesting. I noticed that Star and NICE are listed here. Those are 2 of the PIN debit networks in the United States. There's a whole bunch of PIN debit networks. I mean, there's Excel, which is owned by Fiserv. I think Jack Henry technically has a PIN debit network, so they don't make it very accessible. Alaskan option, I don't know that still exists, but the credit unions have one. CU24, Q-Liance. There's a bunch of PIN debit networks in addition to Star and NICE, plus Visa and MasterCard have their own PIN debit networks, Interlink and Maestro, respectively. So I wonder why Star and NICE are the ones that are included here. Like either this is not a comprehensive list and those are just the top ones, but I'm actually curious and I wouldn't be surprised if there's something fundamentally different with how Star and NICE process their transactions that merits their inclusion on this list while the other PIN networks aren't included. So now it talks about systems with smaller budgets such as ACH. I actually want to jump in on and talk about this a little bit. So Americans love cards. They love credit cards. They love debit cards. They love card transactions. So both, they know how they work. They're very familiar with swipe, with EMV, with typing in their card number online for a card not present transaction. They know how the payments work for debit cards and credit cards. They know how interest works. They are super comfortable and they like using cards. It's their preferred method of payment in most cases. Now, ACH doesn't quite have the same branding advantages. They, you know, I mean, it makes sense. Like Visa is taking out ads at the Super Bowl. ACH is not. A lot of people don't recognize the term. They don't know what its relationship is with direct deposit, which might be a term that they're more familiar with. Are those the same thing? Are they different? Is it a subset or a hierarchical kind of relationship? And let's be honest, ACH not taking out ads at the Super Bowl. So the reason for this, right, is basically credit cards have made a ton of money and the margin's much fatter there. So Visa, MasterCard, the card networks, like they have the budget to do marketing, education, culture. Like it's cool to pay by a card in a way that it's not cool to pay with ACH, right? And like that's reflective of the margin. So I know a lot of tech people in San Francisco are like, ACH payments are so much cheaper. Like, why don't we do everything with ACH and avoid using the card networks? But this isn't just a happenstance. It's like these things are directly related. Like that card transactions are so expensive and not for consumers, for merchants. That's why the margin is fat enough to afford these like big marketing campaigns and both to educate consumers and to make it cool. So I'm kind of like, you know, no wonder people prefer to use cards instead of ACH. There's these operating rules it talks about, including that Visa, MasterCard, and Nasha make most of their operating rules publicly available on their website. Guys, this will be a future FinTech Book Club reading. I can feel it. I'm excited. It will be amazing. And there's an overview of some regulations. I'm most interested in Reg E. There's a bunch of cool stuff for like consumer rights in terms of card transactions. You know, Reg Z is good. Reg CC has also got a bunch of good stuff. Goes into identity checking procedures. Just a small rant here. So, I mean, regulation, I'm a huge fan. Protecting consumers, it's great. We should have more of it. Like, I think anyone who's interested in starting a consumer-friendly company and product, like, should be supportive of regulation. What I would like to complain about is the banks are basically, they're following the USA Patriot Act, which is all about not funding terrorists, not banking terrorists, not providing monetary services for terrorists, right? Great. You have to prevent money laundering, right? You have to try and figure out, well, like, where funds are coming from, not letting people launder money through your institution. And for me, frankly, it's like kind of a matter of like pride and reputation too. It's like, don't let people use your institution for these nefarious purposes. Now, real estate does not have to follow these same regulations, which is a little screwed up. Like, how does real estate have better lobbyists than the banks? You know what I'm saying? But they've basically gotten this exemption year after year that they don't have to know where the funds are coming from. They don't have to like promise not to help terrorists and things like that. And that's why you see these Russian like oligarchs are, you know, using corruption to steal all this money and take it out of Russia, and they're stashing it by buying Manhattan penthouses with all cash. And the real estate agents are happy to take their cash and they don't ask where it's from. While like a bank would never do that, right? A bank is not gonna just accept whatever cash for these things. So I don't know, just a small rant on the Patriot Act and real estate should be regulated. I think it's outrageous that it's not. Quick shout out to money transmitter regulations here. Now, my last company, Pinch, so we were actually licensed as a money transmitter in 2 states, Washington State and Arizona. It's funny here, it says almost every state requires money transmitters to obtain a state license. It is not every state. I think Montana doesn't, maybe Wyoming too. It's hard to build a venture scale business operating just with the customers who live in Montana or Wyoming. So most people do get licensed as money transmitters. It is a pain in the ass because every state has totally different requirements. But it's a way for non-bank entities to handle customer funds. And like I said, I'm pro-regulation. I think it's great that you're regulated. Like, the point of the regulation is to be consumer friendly and to make sure that if somebody has access to your funds, they're not going to run away to Mexico with it. and you have some recourse there. So I'm a fan. What's this stuff? Interchange fees is funny. It's like a bullet point here. It's like this. This is the most neobanks business model is interchange fees. I'm sure we'll get more into it later. I thought this section on exception processing stuck out to me, particularly when I think about the fintech ecosystem and where the opportunities are here. So what this means is that in general, right, things work well. Like if somebody signs up for an account with you, like that just happens automatically. Most payments, it's like you do a purchase transaction, everything just happens automatically. It's easy, it's fast, it's cheap, it's perfect. Where things get gnarly is when an exception happens. And exceptions happen annoyingly often, right? And so I think when you talk about know your customer regulations or anti-money laundering, often what form that takes is that something looks weird. If it looks like it might be money laundering, then those accounts get sent to a queue for manual review, right? And you have a trained person in the United States review that activity and decide whether it's suspicious or not. It's wildly expensive to do this type of thing. And I think the first generation of startups that were working in like the KYC and the AML space were all around data. They've gotten to be really successful by giving institutions more access to data. I think the next generation is going to be more focused on workflow management and saying like today it gets ignored. It's like people have their standard way of doing business, and anything that's weird and different, it's like, oh, we'll figure it out. We don't have to optimize that. It's so expensive that you do have to figure it out though, and you should optimize it. So I think there's going to be a new generation of startups that really focuses on the workflows themselves, like how to go through these review queues. What are the different paths that accounts and transactions can take as they make their way through it? It really reminds me of e-commerce actually. So for e-commerce, often the profitability is driven by their return percentage, right? And that's not just because a return is a sale that they're not making. It's because returns are so manual and so expensive. Like the process of advertising, getting a customer in the door, selling them, processing the payment, doing fulfillment, all of that has been really refined and really optimized. When you get a return, it's like everything is super manual. You're relying on the customer to pack stuff up, put barcodes on, get it in the mail. Like that's probably not going to happen correctly. Then when it gets back to your warehouse, you have to like figure out where it goes, what it is. You have to process refunds. You have to figure out if you can sell it or not. Like all of this stuff is super manual. And that's why e-commerce startups live or die by their return percentage. It's the same with financial institutions, right? Like they can live or die by how efficient they are at processing exceptions in those workflows. And I think that's what this shout out is here too. It says the efficiency with which a provider manages the exception process may significantly affect the overall economics of that product for that provider. And I just couldn't agree more. Same day ACH is going to have an interchange component. That's exciting. I thought this was such a cool part. So it's talking about risk flow, right? So it says, basically what it says here is that if you assume risk, right, you're compensated for that. So riskier transactions, right, it's like you get paid for taking on that risk. A lot of the financial world is about like correctly calculating and monetizing risk, right? And so you get paid. And what Carol says here is that a provider that assumes the risk but does not manage it well or does not understand that it is assuming risk is apt to have a short business life. Now, sure, this is totally true, right? And like you shouldn't do that. But I think the more interesting opportunity side of this is actually the inverse, which is that since riskier transactions are compensated more, if you can take on riskier transactions without materializing that risk, either because of the strength of your fraud program and your monitoring and your queues and all of that stuff, then you're increasing your margin, right? You're creating a better business. And so I think that's actually a more interesting area is like, are there opportunities for people to create businesses in categories that have been traditionally seen, that should not even seen, but like traditionally have a lot more risk, but not actually materialize that risk? And I just thought that was sort of like the next step of this, and the inverse of what it says here that was interesting. whole bunch of types of risk, right? A whole bunch of types of fraud. You know, it talks about whack-a-mole. I think it's really, this is an arms race, right? It's like fraudsters and financial institutions are constantly like leveling up and going up in stages. Now, banked customers don't pay to pay. Unbanked customers generally do. This is one of the really screwed up things with the US. I mean, it's truly like consumer finances, the unbanked pay for everything, right? They pay account maintenance fees, they pay per transaction fees, they pay to cash checks, they pay to send payments. Really the financial system is built off the backs of the unbanked customers, and that's kind of screwed up. And there's some legitimate business reasons that have existed for that historically, but we no longer have that excuse, particularly with technology, right? So like technology makes it much more affordable to serve previously unbanked customers. And I think it's a real travesty that we accept this and put up with this today, because it's just embarrassing that it works like this. I also like this part right here. It says, like, in the US, the card industry started with a highly profitable credit card business. This is what it's talking about with like Visa and MasterCard, right? It's like they're making so much money on credit cards that they can do all this advertising, get consumers stoked about credit cards, both because they understand how they work and because, right, they like it. They think it's cool. And that then the card networks have successfully carried this over into lower margin debit card arena. It's not just the lower margin debit card arena, to be honest. It's extends further than that even, because the card networks are now coming out with push to debit and pull from debit, and these are lower margin still even than debit card. But from the card network's perspective, like, they're really leveraging their brand in order to scoop up this incremental volume. So it's like they were able to afford all this crazy marketing with credit card margins. And now, right, like people are excited about using MasterCard, even in situations where if there was like an independent company, they wouldn't have the marketing budget to support these like lower margin products. It actually kind of reminds me of the whole Invisalign thing. So, you know, Invisalign is the like clear braces thing. Like, I don't know what the business economics are underlying that business, but it's got to be like a pretty healthy margin business, I believe. And so with that margin, they were able to turn that into marketing dollars. So they were educating consumers. They were making it cool. They were showing people like, here's how it works. It does actually work. Here's why it's a good idea. And basically like brought the consumer mindset to be really excited about Invisalign, so that now recently, right, I'm sure you all know, the patent's expired. There's been a whole crop of competitors that are offering the same product, and they're offering it for cheaper, right? And I think the naive perspective is that Invisalign could have been offering it at these prices forever, but the market really had to be made. And Invisalign, it costs money to make a market like that. And so Invisalign paved the way, and these new companies like Smile Direct Club are really, they're working off of the strength of Invisalign's brand, and that they built out getting people excited about it, making sure they know about it. They're asking their dentist about it. They believe that it works. Invisalign did that. And frankly, like, I mean, Invisalign did that with their marketing budget. It's like their marketing budget fundamentally comes from the first customers of Invisalign who are paying quite a bit of money. So they really, I mean, they did the work and paid the price to educate the rest of America. And now everybody gets really cheap, clear braces things. I don't know, what are they called? Retainers? Maybe retainers. Moving on to payments, we got global payments, we got cross-border stuff, we got remittances. Oh yeah, I think this is really my last point here, right? Which is that these large scale, right? So open loop payment systems are highly efficient and scalable. They work super well. They're very inclusive. They're slow as shit, right? And I think that's a criticism that a lot of people have, is that they're really slow. They haven't updated. They still work the same way they always have. But quite frankly, like, it works. And I think that, yes, there's opportunities. We should make it faster. We should make it cheaper. We should make it better. But there is something to be said for the fact that it does work and it's super reliable. And I think that these things are related. All right, now here's a graph summarizing all of the payment system. Guys, I think that's it. I think we finished the chapter. So thanks so much for joining me for the recap, going over my notes of chapter 2 of U.S. payment systems. I'm super excited. We're going to discuss live at the inaugural Fintech Book Club meeting, and I hope to keep making more recap videos. All right, bye guys.